Weekly meeting of the Quest Learning Seminars. We're so happy to have you back. We have two very special guests with us today, Alina and Mike from Tempo, and we will be talking about some things that happened in the pandemic and some really interesting investments converting some of these empty things into multifamily, hotels into multifamily. Is kind of a tongue twister. But before that, we have a short video that I know that you're going to enjoy and probably recognize some names and faces.
My goodness, another downturn for the stock market. How on earth am I going to make money and retire at this rate? There has to be another way to invest my money safely.
There is.
Who said that?
The disembodied voice in your kitchen.
Oh my! Wait, what other way is there?
It's something called a self-directed IRA.
A self-directed IRA?
Yes.
Well, what does it do then, huh?
A self-directed IRA allows you to use your 401k and IRA money to invest in alternative assets such as real estate, notes, and private entities. With self-directed IRAs, you can take control and diversify with alternative investments that you're knowledgeable about, without the uncertainty and fluctuation of the stock market.
Well, that sounds like a swell idea. How do I get one of those?
All you have to do to get started is open up an IRA with Quest Trust Company. You can speak to one of our certified IRA specialists and submit an application in just a few minutes.
How grand! I think I'll call them right now.
But wait, there's more.
There's more.
Don't get burned by the stock market. When you open up an account with Quest Trust Company, we'll send you a free toaster. That's right. When you open an account right now at Quest Trust Company, we'll give you a free toaster. All you have to do is use promo code TOASTER and call 1-855-FUN-IRAs or send us an email.
All right, I hope that y'all enjoyed that. That was our very own Nicole Fana from marketing and our president, Nathan Long, doing that cute little commercial. And yes, we are giving away toasters. I just have a few slides to share before we get started about Quest and kind of who we are and what we do. Let me share my screen here. All right, here we go. And switch it. All right, and we're all ready. All right. Oh, okay, good. There we go. All right. So who is Quest and what do we do? So Quest Trust Company is actually an IRA custodial company started by two brothers, Nathan and Quincy Long, and they were actually investors themselves. So they actually built the company around that experience, what a client would need. We are the largest self-directed IRA custodian in Texas. 20,000 investors all over the country. So no matter where you're watching from right now, we can help you. $2 billion under administration, $350 million in undirected cash. That undirected cash is just cash waiting for an opportunity. So make sure you get in touch with your IRA specialist to see how that could work for you. And of course, our disclaimer, Quest Trust Company does not give any legal, investment, structuring, accounting, tax, etc. advice at all. This webinar is for educational purposes only, and we of course encourage doing your due diligence on any investments that you do inside of your IRA. All right, so what is a self-directed IRA anyway? So self-directed honestly is just a marketing term, and it means you get to direct the account yourself. You are directing us on what to do. And here at Quest, we hold privately held assets. And so we have this platform for all these alternative investments. So just a marketing term, an IRA here is the same as IRA anywhere else, governed the same contribution limits. We just have a bigger platform here for things like diversification. So instead of just having the stock market to invest in, as the commercial said, now you have this whole new world of private assets to invest in. The tax savings are incredible. The traditional IRA is on a pre-tax basis, a tax-deferred account, our Roth IRA, an after-tax account with the possibility of tax-free and penalty-free distributions at retirement. So make sure you're getting in touch with us to see how we can do that with you. Social investing. You get to do things actually like locally or in your community, as opposed to maybe investing in big companies that you don't know anybody at, like in the market. So that's another advantage as well. And then of course, invest in what you know best. This is where you get to shine and use your knowledge. So if you know a lot about real estate or lending or private entities, this could be a place where you can shine. Okay, so types of self-directed accounts here at Quest. We have these 7 accounts: personal, employer, and our specialty plans. I'd love to tell you more about these, but we just don't have time today. So make sure you call us and see which ones work for you. Even if you're an existing client, there could always be another opportunity. All right, so these are our 3 asset classes that we typically hold: real estate, private entities, and promissory notes. But oil and gas isn't even on here, so this is even kind of a short list. Today, of course, we'll be talking about real estate, turning those old hotels into multifamily. So lots of opportunity here. Our new client portal, we revamped this in April. Lots of new features. You can do all of your investments online, expense pay online, get to your secure message center, upload your FMVs. So make sure you check out our new client portal. All right, we offer endless free education like you are doing right now. Every Tuesday and Thursday at noon Central, we have another class with another set of amazing speakers for you. Every Saturday at noon Central, we have Self-Directed Saturday with, yes, you got it, another guest speaker to help you get more education on these self-directed accounts. Our YouTube channel is really, really amazing. Our marketing team has worked so hard. This class right now is actually streaming live on YouTube, and you can watch it there under the video section where all our other webinars are located. Our education center on our website is also full of articles and videos to help you out. And this is our virtual networking happy hour. It's been virtual, of course, for the past roughly 1.5 years. This is a really fun event. The first and third Wednesday of the month. Come have a glass of wine with us. It's virtual. You can do it from your couch. A great way to meet other investors, kind of see what they're doing, get to ask questions to them directly. So join us for that. All right. So some special events we have coming up. July, we have our summer intensive. So these dates are actually Fridays. And from 9 a.m. to noon, we'll be discussing a different asset class each day. So we'll go over the promissory notes, real estate, and private entities. So make sure you mark your calendars for this. All right, so this promotion actually just came out today, and we're running it through next Friday. So it is double rewards. So if you already have a Quest account and you refer someone to Quest and they open an account, you get a $50 credit towards your account, and they get a $50 credit towards the account opening fee. So it's double the rewards. So instead of $25, it's $50. So make sure you tell your friends about Quest, open your account, then you're the one that can start getting that credit when you refer others to us. So make sure you check that out on our website. Another amazing thing we're doing right now, rewards for deposits. This is for new and existing customers. You can see the table here on the screen. So if you're transferring in $100,000, for example, we'll give you $125 in credit on your account. So make sure you're funding those accounts after you open them too, guys. All right, and of course, you get that toaster. Of course, you get that. You can have the toaster with it. So don't get burned by the stock market this summer. Of course, you get your free toaster. And that is a picture of what it actually looks like. And it's a great toaster. All right, so how to get in touch with us. We're very easy to get in touch with us. This QR code actually works. We tested it. Chat with us live. If you go to our website, the chat box pops up. It's actually us. It's not robots. We get that question a lot. Helping me moderate today is Evan Reeves. He's another IRA specialist. Evan and I are on the chat a couple days a week. So come ask us some questions. Or give us a call, 855-FUN-IRAs. I love our phone number. We really do try to make it fun. Or email us directly at iraspecialist@questtrust.com. Oh, I went too far. Or mine is nicole.baco@questtrust.com. I'll put that in the box for you. All right, so enough of me. I know that y'all really came here to see Alina and Mike. So without further ado, please take it away, guys. Thanks so much for being here. Just unmute.
Nicole,
There we go.
thank you so much.
Perfect.
Mike and I are thrilled to be here. Evan, Nicole, thank you for making this happen for Mike and I. I'm going to share my screen. Let me make sure that you guys can see it. So the topic of today's educational presentation is hotels conversion to affordable multifamily housing. And honestly, after the commercial that you guys had, I would like one of those old-fashioned toasters. That looks amazing. Reminds me of a good old times. It's really great commercial. So thanks for putting it on. Anyway, our attorney always asks us to put the disclaimer on that this is for educational purposes only. We're not selling or promoting any sort of securities, and I'll let everyone read this on their own. I'm not going to bore you with reading this content. I'm sure you've seen it many times, but we are required to put on this wonderful disclaimer. So let's start with the brief introductions of Mike and I. I'll hand Mike the microphone so he can tell you a little bit about himself. Go ahead, Mike.
Thank you, Alina. So I'm known as the Big Mike, maybe because I'm a tiny guy, only 6'4", a little bit on a heavy side. So I do go as a Big Mike. I live in Brooklyn, New York, married to my lovely wife for almost 22 years. We have 4 kids and a cat, the 5th child. Those of you with pets can appreciate that. I'm a fund manager full-time since 2009 and a part-time passive investor since 2000. Real estate is my passion, something that I love to do. And we have a family of funds, Tempo Family of Funds, Tempo Opportunity Fund. It's our income and growth fund. We have Tempo Growth Fund, our growth fund, and we recently launched Tempo Income Fund, which is a pure income fund. Previously, I had a career in software, almost 15 years. And again, as I said, went full-time into real estate as a fund manager in 2009. And we specialize in some bridge financing as well as long-term equity investments with predictable cash flow and value-driven appreciation in broad range of commercial and residential real estate, including what we're going to talk about today, conversion of hotels to affordable multifamily housing. To have a podcast out called Big Mike Fund Podcast. Could not get more creative than that. And I have a book out on Amazon, How to Choose a Smart Real Estate Investment Fund, top 10 questions to ask before investing in a fund. Thank you kindly.
Thank you, Mike. I'll give my brief story. So for me, the journey started almost 25 years ago when I was choosing my career, and I decided based on a stereotype to choose accounting because someone said if you're good with numbers, go into accounting, you'll like it. I was really good with numbers. I didn't really enjoy accounting. I got a degree in accounting, then went into public and private. And after trying it for some time, I went into the information technology world, where I spent 20 years and had a successful career. And while in the technology world, my career was growing and so was my husband's. And along with that, we're growing our tax brackets. And that kept me thinking about finding ways to lower tax implications. I couldn't lower, and I didn't want to lower tax brackets. I wanted to lower tax impact. So I kept looking for ways to minimize taxes, and real estate kept coming up. And along the way, I read Rich Dad Poor Dad by Robert Kiyosaki, and the book made a huge impact on me, such huge that when I found the teenage version, I made both of my kids read the teenage version of the same book. And so after doing the research, I finally decided to take action, and I started investing as an equity partner in syndications about 8 years ago. And after doing that for a while and sharing that with my coworkers, friends, family, I realized that most people have never heard of syndication. So I wanted to change that and help other people to learn more and find out more about this passive way to invest, save on taxes, and build wealth absolutely passively without any interruption to their day-to-day life. So with that, I started my own company, Samo Financial, which to this day provides passive investor education and explains how investing through syndications work. And then about a year ago, slightly less, Mike and I were introduced by a mutual friend of ours who said that we should just talk, and we started talking, and we quickly realized that it would be great to start working together. So Mike offered me to join Tampa Group, which I did earlier this year. I joined TF Management Group as an investor relations person this year, and have been working with the team. Really happy, great team. So I'm really enjoying this new journey. So why people invest with us? There are several reasons, and in general, it all comes down to the previous experiences. Mike mentioned he's been in real estate for 20 years, and while he's been a fund manager for over a decade, he's built extensive relationship through this time. And the same applies to me. When I started my company, I started building relationship with the other real estate investors and operators, and through these relationships we're able to find the projects that make sense for our funds and for our investors community. And while building our funds, we always have in mind diversification. We're trying to maximize the number of projects that we have in our funds and allow to diversify our funds by bringing various assets into different funds. We also have access to the best of the best deals through this relationship, because we're able, through this long-term relationship, find the best operators, and by that we're bringing the best projects into our funds that are serving specific goals within each of the funds, as Mike mentioned, whether it's an income fund or a growth fund and so forth. And in general, our philosophy is we put our investors community first. So we are servants by nature, and for us it's really important to make sure that investors' interests are met first. And that's why when we're building our funds and finding the projects for our funds, we're always thinking about our community first and how we can benefit them and how they will benefit for each specific project in particular. Transparency is also one of our key priorities. We always tell the story like it is, when the times are good and when the times are bad. And, you know, obviously pandemic has impacted a lot of us in one way or the other. It has impacted us in some way as well. And we have been always fully transparent with our investors, telling them the story like it is, explaining why the projects are progressing in a particular way and how we think it's going to change after the pandemic would be over and so forth. In terms of the communications, we strive to over communicate. So we always do, I'll give you an example. When we provide our updates, we typically do on our projects, we typically do it on a quarterly basis. So it's done through the email, and then we do the webinar, and then we also record the webinar and provide the recording to our investors. So, and if anyone wasn't able to join the live webinar or has a follow-up questions afterwards, we're always available and always answer our investor questions. And happy to hop on a call with them and explain what's going on and why things are going a certain way. So while the world was waiting and finally got the vaccine early in the year to effectively end the pandemic, the hospitality industry was scrambling, to buy the time to stay afloat. And since March of 2020, US hotels have lost billions of dollars in revenue. Many of the hotels had to close, and that in particular impacted the luxury ones. Occupancy levels showed what happened. In early May, the occupancy was less than 15% in luxury hotels and around 40% for the economy hotels. And although some hotels were banking on staycation, other hotels were focusing on safety and sanitization to remain open, and many of them will probably not even survive. So a lot of them were thinking, what can be done with a growing inventory of the failing hotels. One of the answers at that point was to potentially convert such properties to a higher and better use, and specifically to multifamily housing. According to the McKinsey and Company article that was dated June 10, 2020, hotel industry study suggested that the recovery to the pre-pandemic levels could take up until 2023 or even later to achieve. For many hotel owners, this is just way too long to wait, and some of them have been forced to sell at a steep discount or just close down completely. Unlike the hospitality industry, multifamily has always been in high demand, and this has been especially true for the workforce housing. Many apartment developers have largely focused on Class A properties where premium rents can typically justify higher construction costs. In the meantime, affordable housing options have been dwindling, and there has been a ready-made demand for the workforce housing that vacant or failing hotel could potentially fill in, provided that the hotel property is the right fit for such conversion. A few various sources of capital would typically finance this kind of project, including banks, debt funds, and maybe some local private money lenders. Whatever the source is, the lenders always want to put an emphasis on scrutinizing the sponsorship team's experience and financial strength to determine if such project is viable in the first place. The unfortunate reality was that there was no clear end in sight for the economic distress caused by the pandemic. So a few operators decided to take a look what this potential conversion, what kind of opportunity this potential conversion can present. So the opportunity in general entailed the two-step process. First, it was buying the hotel that was in a distressed state, and second, it was converting such hotel into the affordable housing. To implement such conversion, the following 5 steps would have to be followed. Number 1, finding a hotel that either was offered through REO, the bank-owned property, or through the short sale. Detailing the plan for conversion, including all of the renovations. Number 3, as the units would get renovated, start leasing them up. Once the property will be fully stabilized, refinance it, and then finally hold it as a cash flowing asset or sell it to the right buyer. While these 5 steps may sound easy, the operator must be very experienced to know how to specifically execute all of these steps. So let's not sugarcoat this process. Converting hotel is not an easy task, and you're taking a building with a specific business model and repurposing it for a completely different model. So the strategies in general would be to find a low-rise hotels that are typically maybe 1 to 3 stories, buy them at a steep discount, then work on some kitchen area retrofitting and combining of the rooms to increase the square footage. In some cases, the hotel units may be split up into either efficiency or 1 bedroom, or in some instances into 2 bedroom units, depending on the demand in a particular geographic location. So let's go through a few examples. Mike, would you please take us through these examples?
Sure. Thank you, Alina, for that great overview of the concept. Now we'll look into a live example of what happened pre-pandemic. So the concept itself is not new. It has, the idea has existed in the past. So pandemic just knocked out a few hotels that were damaged in the past. And some of these conversion projects made great sense regardless of the pandemic. So this is an example. We made an investment into a project in Ogden, Utah, conversion of this boutique hotel, which is not your classic conversion example. It is sort of a high riser, but it was a pretty good conversion opportunity. And this particular property was converting to high-end multifamily, not necessarily affordable. But that's just an example of how it can work if it's executed well. So this particular project was funded in May of 2019, pre-pandemic, and it went through the life cycle. It went through the renovations and lease up and full stabilization through the pandemic, and it sold in February of 2021, sort of in the middle of the COVID. But here's an example of what a strong execution can do for investors. Alina, please go back to the previous slide. So here's an example that the total investment in the project was approximately $13.5 million, with a target to sell the property at $18.8 million in 5 years. The property, in fact, sold for over $20.5 million in 21 months. The result of this faster sale at a higher price was the return to investors, what is known as the IRR, internal rate of return, was over 73% per year. So it's a very, it's a home run type of a deal, and it happened sort of, they exited right in the middle of pandemic, proving this thesis, this theory made sense on some assets before pandemic and just accelerated throughout the COVID. And even though the economy is recovering and the demand for hotels has gone up quite a bit, we're still seeing plenty of good opportunities in the secondary, tertiary markets for non-vacation properties, for the properties that are just naturally fit into the residential neighborhoods, and they're not destination hotels. Destination hotels are seeing good demand now, but there are plenty of sort of plain vanilla, boring hotels that are still great conversions. Let's keep moving forward. Here's an example. So Temple Growth Fund, our flagship growth fund, is invested in a conversion of a Residence Inn 88-door hotel in Winston-Salem, North Carolina, to affordable multifamily housing. So the hotel, it wasn't that old. It was built in the mid-'80s, and it had recent renovations in the 2012 and 2013. The property was distressed through the COVID, and then upon completion of the foreclosure, the property sold immediately with a plan to convert. And the conversion process itself is fairly easy. So these extended stay hotels conversion is almost natural because they often have small kitchenettes built in. The consequence is this is a lightweight conversion that can be executed under 12 months and then fully stabilized and refinanced within 18 months. So the opportunity to take a dysfunctional hotel and convert to affordable multifamily is very welcome with many cities and towns. And this particular property is a mile away from the Wake Forest University and 6 miles from the Wake Forest Baptist Medical Center. So this is an opportunity that happened in the post-pandemic world, and it's a great project, and everything we're hearing is progressing incredibly well, and the results may be another home run, or at least a strong double or a triple. Please continue. So here are the economics on the deal. The acquisition price for this property, 88 doors, was $4.6 million, and the incremental construction budget is fairly light because these units look like apartments already, naturally. So overall, total capitalization on the deal with construction budget, all the working capital, all the legal, is $5.9 million, of which Temple Growth Fund invested $1 million and $1.5 million total equity, and then there was also senior debt and a mezzanine debt. And total debt was $4.4 million and equity was $1.5 million. And the target sales price upon completion is around $8 million. From what we heard, again, this is a whisper, how these projects can go. There's already interest to buy this property in the $9 to $10 million range. So when the buyers come out looking for great assets and they're willing to pay top dollar for it, the returns to investors are phenomenal. So this is an example where it could outperform. Again, full disclaimer, the project is in progress. We don't know how things are going to play out. But what we heard, there's a very strong demand for these type of assets upon completion of the conversion. And the projection on this deal. So just to give you economics, when we invested, the projection was that it was going to essentially complete construction and full stabilization 15 18 months, then refinance, return good amount of capital, and then hold for 5 years with a target return of 21.5%. But if it sells for a higher price, well above the projected, or faster, or both, the returns could be substantially higher. So it's just how math works. Because these deals have leverage, the leverage returns get very magnified if the sales price is higher than the projection, or the return or sale event happens a lot faster. Here's another example. This is a Ramada Inn conversion in Mesa, Arizona, downtown Mesa, Arizona. Great location, right next to light rail train stop. And this is a different flavor than the Residence Inn conversion. So this is a hotel that looks like a motel versus the other one is an extended stay hotel. So the motel flavor, these are small studios, typically 300 square feet, could be less, could be more, but they're small. And in this particular location, the conversion is taking place effectively. Most of the units going to be capped without breaking walls or changing things into, they will be kept as studios with the kitchenette installed. They could be great for as student housing. Many students could commute through the light rail to the universities and stay in this property. It's a lot better to have the privacy of your own studio than living on campus and paying a higher price. So affordability is much better. Also, just workforce housing. Essentially, a lot of people work hard and they need a place to crash, and they don't need a lot of space. So these studios work very well as the most affordable product on the market. So this particular one is approximately 60,000 rentable square feet, and the rents offered well below the market average. Again, the submarket, Mesa, Arizona, it's a great submarket, workforce housing. There's a lot of demand for this type of product, and it supports Greater Phoenix area, and we love the market. So here are the economics on the deal. The acquisition price for this property was $6.8 million. So the construction here is heavier. As you can see, it is your typical two-story hotel with the kind of inside courtyard having the pool and some sunbathing area and a few other facilities. But because the asset was aged, it needed brand new roofs and a lot of additional renovation. So as you can see, the renovation budget of $3.1 million, almost half of the acquisition price, is very substantial, and it's more work. At the same time, the project still has great economics because of its location in downtown Mesa. So all-in cost on this deal is approximately $11 million. With the equity investment, we're participating in the equity on this deal. Total equity pool was $4.2 million, and the debt, the bank loan, was $6.75. The target sales price upon completion of the conversion is $15.1 million, generating pretty good return on equity, doubling the equity. Again, what we're hearing, a whisper and a rumor, the demand is really strong, and there are buyers who are kind of circling this property with a whisper price somewhere around $18 million. So when you look at these deals, it gets really, the math starts working out a whole lot better if there is high demand and the sales price is far above the projected number. But the project makes good sense even at $15 million sales price. Very similar life cycle on the construction work, approximately 15 to 18 months, full construction and stabilization work. Typically, if there's no sale, then there is a refinancing event to get long-term, typically Fannie Mae or Freddie Mac mortgage on a fully stabilized property. And on a 5-year hold, the projection was to generate investors' target return a little over 20%. Obviously, if it sells at a higher price, these return numbers could be a lot higher. Again, full disclaimer, The project is in the middle of its life cycle. We don't know how it's going to pan out, but we're hearing very positive rumors and whispers.
Thank you, Mike. I'll take over from here.
Thank you, Alina.
In general, prior to considering such purchase of buying a hotel and then converting it, it is always advisable to determine whether such conversion is feasible for your property. So in order to do that, you have to perform a number of feasibility studies. These feasibility studies typically answer the questions such as, what is the macroeconomic environment of the area? What does the employment, income growth, population growth, demographic characteristics are telling you? Where is geographic area is going in general? What is the current and the future market demand for a particular asset type that you're trying to convert it to? What is the potential competition in the area? Are there other affordable housing, not just multifamily in general, but affordable housing properties in the area? And what are they show? What are the numbers showing? Are they full? Do they have a lot of vacancy? What condition are they in? What kind of rents can they support? Also, what are the state and local regulations that need to be considered? In addition to that, what are the potential costs that will be associated with such investment? The studies that you see listed will answer these and all other questions, and they are typically pretty extensive and take a very long time. So the process before the conversion starts, all of such due diligence would have to happen to determine whether it makes sense to proceed with such conversion. This completes our educational presentation for today. I hope it was educational in nature and provided you guys with some food for thoughts. Mike and I welcome any questions, and if anyone wants to reach out later on, our contact information is listed on this slide. Thank you.
Thank you all. Let's hear some questions. And while people are typing in questions, I'll add just one more interesting comment. So people have asked, so why conversions versus the new construction? Why does it make sense in this environment? And it's a very fundamentally important question. So the reason conversions present better opportunity in my view is that in the age of inflation and in the age of construction materials going through the roof, and then the labor costs are going higher. The construction itself, the bigger the construction project, the more risk you're taking as the variance of the costs is higher. So on the conversion projects, even though there's still work involved, but it's a lot lighter work, the predictability is better. And as a result, we as fund managers feel that these projects present better investment opportunity versus the ground up projects where the uncertainty is higher, just fundamental high level. And for comparison sake, a lot of these conversion projects create a multifamily property well below the reconstruction cost. So, which is another very important characteristic where it could generate same amount of income at a lower cost basis versus a newly constructed property, as the cost of construction for a ground up is a lot higher. So we'd love to answer questions. Let's take a look what's in the chat.
All right. So while people are still putting them in there, I had a couple questions. One, thank you so much for sharing all that information. I learned a ton today. Thank you. So I saw that you had a investment or these conversions in different markets. I saw some were in, I believe, Utah, and we had like in North Carolina. How do you pick those markets, or do you have a method of doing that?
Nicole, great question. So we just pick them. No, I'm kidding. We're not picking the markets. We're picking the operators. So we are fund managers. We invest with the top operators. We don't do conversions ourselves, just to be very clear. We're not jacks of all trades. We are capital allocators. We find the most experienced operators who identify these projects, and we invest with them. So we have a programmatic or systematic relationship with a very, very competent operator who does these projects, and we go where they go. So they find these projects in various markets through their relationships. So for example, the Winston-Salem project was an REO, was a foreclosed property. We have another one with the same group in South Bend, Indiana. Why those places? Because they both were bought from the same bank as a part of the foreclose. Once they foreclosed, they got bought, and they wound up in those markets. So if the price is right, you'll go anywhere as long as the numbers work. That's why the deal location selection has nothing to do with the specific market. It has to do where the opportunity is, where the deal's kind of coming through, and with the right operator. That's the key message here.
Perfect. Thank you so much. We do have a couple questions that have come in. This is from Mary Ann. How many conversions have you done, and what kind of discount are you looking for on acquisition?
Sure. So off the top of my head, I believe we have 8 projects between Tempo Opportunity and Tempo Growth Fund. Most of them are in Tempo Growth Fund, as we kind of piled up on this strategy after the pandemic hit, as the best opportunities took place then. So we did 1 pre-pandemic and 7 or 8 post-pandemic. As far as what discount, it depends. But as you can see, typically the spread between all-in cost basis and then the future value conservatively, we typically want to be all in at around 75% or better of the future value. That creates a pretty decent margin of safety. It's a forced appreciation. Even if the market corrects, we have the safety because we're all in for $6 million. It should be worth at least $8 million. On the Mesa, Arizona, we're all in for 11. It should be worth 15 plus. So the 75% ratio is a pretty good ratio. If we can get better, that's great. Some projects get a little tighter. You wind up in the high 70s. But in general, that 75% range is the right target, all in, of the future value.
Okay, wonderful. What is the average buy-in? And then they had a range 25,000, 50, 75,000. And the second part to that question was, do you have any active offerings?
I think the person is referring to the minimum amount to invest in our funds. So that varies. It starts at 100K and then goes up from that point. Each fund has its own baseline amount that we request to bring in. All of our investors have to be accredited in general. And in terms of the active offerings, so because we build blind pool funds in general, we typically always have a fund or multiple funds that are open to new investors, and we bring new projects into those funds. I hope that answers the question.
I think it did. Let's see. There was one other thing that I wanted. So is there anything really specific that would be close to the property or to the hotel that you're going to convert that you really look for before doing that?
Sure.
Like certain amenities or places or
location. You heard that in real estate, right? So it's always starts with location. It has to naturally fit as a multifamily in that area. So you don't want to take a hotel off the highway in the middle of nowhere, right? That wouldn't work very well. But if a hotel is in a great area with shopping, with the restaurants, service industry around it, so that people would love to live there, that becomes a key characteristic. So location is always important. After that, we typically look at economics. Does the deal make sense? What is the acquisition price? What will be the cost of construction? And what is the all-in cost relative to the future value based on valuation of the property in that area or similar assets? So always location, then economics. Economics could look great, but if location is not good, you don't want to be in the wrong place. So it's that simple.
Well, that makes sense. One more. Can you please explain the JCurve when doing a Roth conversion while invested in a multifamily deal?
Sure. So this question is music to my ears because we had a previous presentation, I think, with Quest on this subject, investing into a growth fund like Tempo Growth Fund and using a growth fund or a growth one-off syndication to convert from traditional to a Roth at the bottom of the J-curve. So the J-curve is a concept where when there's an investment in a project that does a lot of value-add work. A conversion of a hotel to multifamily is that. So when folks invest in a Temple Growth fund, as an example, and the fund has a lot of these conversion projects, these projects pass through a lot of losses initially. They just don't generate income. You basically stopped a working hotel and you start converting it into a multifamily asset. So some amount of time into the life cycle of a project or a fund, the returns essentially bottom out. All the kind of the downside, all the losses have been accrued, and then they show through statements, and the value of the investment now on paper looks less than what people did in cash. So for example, somebody can write a check for $100,000, and 2 years into the deal or a year and a half, it could be worth only 70,000, and then they could convert from traditional to Roth at that point at a $70,000 value and save on taxes. So the concept makes a ton of sense. Again, any type of a value-add growth project could be a candidate. A fund like Temple Growth Fund, or could be one-off conversion of a hotel. It could be a heavy value-add multifamily where there's a lot of heavy lifting. And why the J-curve is because the income is stopped. There are expenses, taxes, insurance, other expenses. So the returns look negative for a number of quarters initially until the project is stabilized and then lease up starts. So that idea is very powerful and makes total sense. And Temple Growth Fund can be used as a vehicle to do that. In fact, we went through a discussion. We even identified a CPA who'd be willing to do a study, a third-party CPA, to do a study and put together a letter of opinion what that investment is worth at that point of time, because we know the Quest process. We literally spoke with a few Quest folks, and they said the Quest doesn't appraise these assets; they just document. So you need an opinion from a CPA or an appraiser. Mm-hmm. So as long as there's proper documentation, you're able to convert at a low valuation with the proper paperwork supporting it.
Well, that makes a lot of sense. Thank you so much for that one. Let's see. Something I like to ask everybody that comes on these webinars would be, what would your one golden nugget of advice be? Always people that are kind of looking to get into this type of investment.
Nicola, I say that to everyone, regardless whether it's real estate or any other alternative. In general, always educate yourself first before taking the next step. You need to understand what you're investing in. And you need to make an intelligent decision when investing. So that's definitely my golden nugget.
I like that. Here at Quest, we certainly like education. So that makes a lot of sense. Mike, do you have a last golden nugget that you would recommend to people?
I'll support what Alina said, because I have this question. I answered this question with a question. Are you investing to learn or learning to invest? Think about it. Of course, the most important investment you can make is in your own education. So the more you know, the more educated you are, the better you invested in investment decisions. So sometimes people invest to learn because that's a better investment than throwing the money into something you don't understand. At some point, you're ready. And when you're ready, that's when you pull the trigger and you take action. But before that, educate yourself. So I agree with Alina's point.
I like that. I like all the education. We have another question. With all of the leverage, what kind of UDFI tax can we expect? And it might not be something you can answer.
We can. Specific. It's a great question. So again, I'm the full disclaimer. I'm not a CPA. I don't play one on TV. I don't give advice, right? This is a matter of opinion under the First Amendment, right? So consult with your CPA, please. UDFI or UBIT tax technically is due on leverage deals. So it's a great question. The leverage depends. Some projects will have 60% leverage. Some projects will have 70% leverage. Some will have 75. Hard for me to say, but in theory, there is some UBIT that could be due, or UDFI related to leverage. So you're asking the right question. The answer is consult with your CPA. The question could also be very specific to an individual investor situation. Also, while we're in the subject, as folks invest, when they sell the asset and the gains and taxes are due, can they roll the capital into the next deal and use passive allocation losses from the next project to offset the gains from the previous one? So that's strategies that folks could use even with the theoretically tax due on sale to defer the liability and until the next project. So yeah, I mean, it requires tax planning, it requires work with the CPA, it requires understanding, but the fact that they asking the question, they understand that there is a little bit of risk. By the way, most of the investments in our growth funds, because they pass through a lot of losses, there is no UBIT or UDFI initially because there's no gains. What happens is on gain on sale. That's how I would interpret the question. At that point, technically there is some UDFI due to the leverage, but if you invest in the next deal, I believe, again, not a CPA, don't give CPA advice, you could use the losses from the next deal to offset and to kick the can down the road and continue to grow your investment within the IRA, tax deferred or tax free if it's Roth.
Oh, I like that.
There is also a way to avoid that if you're qualified to open your solo 401k, you have a business and have only family members working on it, open a solo 401k, which fits the exception of not paying the unrelated debt finance income tax. So that will exclude you from any tax whatsoever.
Yeah, that's a great point, Alina. Yeah, 401ks have that exception. So that's a great point.
Yeah, here at Quest, we have a solo 401k. So if that's something that y'all are thinking about, of course, call us up and let us know. Well, I can't thank you enough for y'all coming today. This is a really big learning experience. I learned a lot, and I can't thank y'all enough for coming. And do y'all mind putting your contact information up one more time just to make sure people can access it?
Sure, absolutely.
Just to make sure everybody can get your contact information should they need to reach out.
Folks, please reach out to Alina first. She is she's the right specialist. I'm a little bit rough on the edges. I'm the big Mike, and Alina is a much better at questions and investor relations. But we appreciate your interest. And once you chat with Alina, she'll follow up she'll schedule a call with me through the scheduling link.
Perfect. Well, thanks again for all of the information. I thought it was really, really interesting. I learned a ton. It was a lot of fun today at lunch. All right, guys. Well, we will be back on Thursday at noon for another class here at Quest for free endless education. It was a pleasure to have y'all today. Enjoy the rest of your afternoon. Make sure you get in touch with those IRA specialists to help you out. And we have our wonderful guest contact information up on the screen and the IRA specialist information in the chat box. So make sure you reach out to us for any questions. All right, guys. Again, I thank you for being here and everybody have a wonderful afternoon.
Thank you.
Bye, guys.
Bye.